Yo, yo, yo. What is up, guys? Welcome to a brand new episode of Thompson's Two Cents. I'm your host, Larry Thompson. I will be today kind of going through the case for ETFs. All right, we're going to call this the ETF Explorer today. I think there's a lot of underrated reasons that people forget about that why they're not looking at ETFs and kind of the components within those ETFs and just kind of some of the edge that can exist by doing some analysis of ETFs and owning them, right? So just starting off the bat, when you think about ETFs, you got to understand the S&P 500, the SPY is an ETF, right? This is a ETF that makes up 500 stocks, right? As we know, overweighted towards those tech-heavy sectors, but it is an ETF. One of the benefits of an ETF is this one chart that's in front of you guys, the S&P 500. This one chart represents a picture of 500 stocks on a momentum basis, right? A market cap weighted basis, their performance. And it gives you information to look within the market. And that's what all ETFs do, right? A lot of ETFs gives you that ability to have a overall top-down view of the market. And then you can take those ETFs and break them apart and do a bottom-up analysis. Another great tool when it comes to ETFs is the ability to diversify. Right, so we're looking at the S&P 500 right now, but in a minute we'll take a look at the S&P 500 equal weight, something that gives you exposure to an entirely different complex weighting situation for the market. Another thing we can look at with ETFs is if you like, say, home builders, for example, and you don't like the individual chart of Lennar or D.H. Horton, right, or Sherwin-Williams or Home Depot that make up, say, the home construction ETF, you can actually use an ETF if it has a better risk reward scenario for you as a whole. So I think the cases for ETFs is underrated. I think there's a lot of single story stocks that gives you opposed single story, single stock risk, right? We think about Tesla yesterday in the news and even today in the news and how, right, that's an impact to Tesla individually, but maybe you wanted Tesla exposure, so you looked at something different, like the MAGs, for example. So let's kind of dive in here. I'm going to go through a few different ETFs. And then at the end, I'm going to give you kind of one of my favorite setups I see for an ETF. And I'm just going to start from the top down. So one of the reasons I love ETFs is we can just do quick analysis of the market without the need to look at all the stocks within it, right? If you're someone at home, it's a busy Friday afternoon, right? You have an hour at lunch to look at the market. There's a million ways you could do it, but one of the ways is just having a couple select ETFs. So let's start here with the S&P 500, right? Strong uptrend. You can see here, we're above that 200-day, we're above that 560 level. It's just all green shoots here, right? I think above this 600, this 598 level is a breakout. 3-month highs were made earlier this week. We've had a little bit of consolidation, but this is on the verge of breaking out here. This is this little base pattern right above that 200-day. No reason not to be bullish when it comes to the S&P 500, right? But what do we know about the S&P 500? 30% tech, right? Well, what can we do to look at breadth of the S&P 500 very quickly? There's an ETF for that, right? So let's go here and let's look at something like RSP, which is Invesco S&P 500 Equal Weight ETF. Another example of how we can quickly look at the S&P 500 now on an equal weight basis to understand the breadth underneath the surface of the market, right? So we know market cap weighted perspective, we look good. You look here at the S&P 500 equal weight ETF, and what do you see? You see the similar, right? You see that rally post-April, mid-April, and you see this base building above the 200-day, above support, above that all-time high AVWAP, like we see on so many other charts. And so what's that tell you? It tells you that we went from a correcting market to now a market that has breadth, and that's a feature of bull markets. So with two charts, right, two ETFs, you can see that the trend is up, that stocks are going up. More stocks are going up than down in the S&P 500 because that's what the equal weight does. And so this is another chart here, right? If you don't know how to get individual exposure, this is something you can just be long against this 175 level and use maybe the all-time high AVWAP or the 200-day moving average, which kind of aligns pretty well. You can use either one of those as your levels to manage risk against and get exposure outside of the tech-heavy top tier names that make up the S&P 500. So that's what I think these ETFs gives you the ability to do. And we'll kind of get more into a few others here, but that's just kind of the overview. So say, for example, you're curious about the Tesla news yesterday and you want to be long those Mag 7 names, but you don't want to have all the exposure just to one of them. Guess what? There's an ETF for that, right? There's another ETF, and this business of ETFs is just one that continues to grow as people understand they have benefits that we've already mentioned when it comes to them. So here we go. We have Round Hill Big Tech ETF, right? It holds Tesla, Nvidia, Amazon, Microsoft, Google, Apple, and Meta equally, right? So as some would refer to those, the Mag 7, right? So it's MAGS is the ticker here. And so we know breadth underneath the surface looks good. We know from a market cap weight perspective, we look good. One of the things we want to make sure of when we're analyzing the S&P 500 are what are the leaders doing? Because we understand these are over 30% of that S&P 500 as a whole. So a trick we can do here is we can pull up this ETF, the MAGS ETF, and we can quickly see this is also doing what those other ETFs are doing, right? The story is the same. We're seeing the recovery, reclaim of the 200-day, reclaim of the all-time high AVWAP, and we've seen a consolidation sideways, right? So the leaders, despite the news yesterday, right, they're just consolidating sideways, and we saw a big rip today. So this is the type of way you can use these to see that underneath the surface, right? And then at the top level of the surface, looking at the largest components, and then looking at the smaller components from an equal weight perspective, the market is consolidating above key support. What's that tell you? It tells you to be opportunistic in this market. It tells you these stocks are most likely going to resolve in the direction of the underlying trend, which is up. And so that's the benefit when you are able to do this analysis, is you're able to see, okay, let me look at these select ETFs and get a bigger picture view of the market and maybe have exposure that's not just one stock risk heavy. Because we look at something like Tesla, what happened yesterday, a 20% drawdown. That's something a lot of people can't stomach, right? There's theory and then there's practice. It's easy to say you can stomach a 20% drawdown after it happens, but in the moment it hurts, right? And everyone tells you they stomached it after we've gotten out of it, right? That's the irony of all of this. Everyone tells you, yeah, I was able to stomach that 20% drawdown after. They don't tell you it during. Yeah, I'm still sitting in that 20% drawdown, right? They tell you after the case. So those are three ETFs, right? You have RSP, equal weight perspective. Quick overview of the S&P 500 from a breadth level, right? You have the S&P, the bread and butter of the market, right? You can see here, easy way to understand the market. And then if you just want to look at the leaders, you have MAGS, Round Hill Big Tech ETF, that allows you to just look at the Mag 7 on an equally weighted basis and understand how they're doing as a whole, because we know that as a whole, that's what matters. One individual one can do pretty poorly, but if the other six are doing well, we can continue to have that uplift in the market. And so that's what we're seeing here. We're not only seeing the leaders do well, we're seeing underneath the surface, we also have broader participation in the market. And that's just by looking at three different ETFs. The next thing, right? You want to look at something that's a little more risk on, risk off. We have ETFs for that. One area of the market that's been struggling all year that everyone is aware of, right, is small caps. Something that's been a chronic underperformer for I don't know how many years now. But look, we can quickly look at the Russell 2000, right? Made up of 2,000 components, those small caps as people call them, right? Smaller names, smaller market caps in general. What do we see? Similar picture, right? It's just a little bit slower in terms of its progress, right? It just took a little bit longer for this one to kind of get it back under its feet. But you see here, look, we're reclaiming this 210 level, which we ran a year-to-date AVWAP for this one, right? Year-to-date AVWAP. We also have the 200-day, which is still sitting below. But we also can see this pattern building where we have a base breakout on our hands, right? We have the base, right? Scoop and score, some may call it. We have this base getting above this 210 level, right? Getting above that AVWAP, which what do you have now? You have clean risk reward. You have a good hand that you can play in poker, right? And that's what this game is all about. It's not about predicting whether or not we get through the 200-day. It's about understanding that now I have a clear level to manage risk against this 210, or you can use the pivot low around 200. right? You have clean levels to manage risk against where not only am I seeing that, everyone else in the market is seeing it. Everyone else is seeing this broader participation now take place. And so you should be opportunistic in this environment. And that's what these charts are showing us, right? And that's the beauty of these ETFs is you don't have to give anecdotal evidence of look at this one stock, right? We want to take a weight of the evidence approach. And with a lot of these ETFs, that's what they do. They aggregate all the charts together for you. So then you're able to see from a broader perspective how the market is doing, which is great for people that can't commit, their entire weekends like myself to looking at charts. But that's why we do this for you, right? So I think something like small caps getting above this 210 level is huge for the market, up, right? 150 basis points today, 1.5%, closing above 210. You can see here this downtrend is starting to fade, right? Look at IWM versus S&P 500. You're starting to see the downtrend fade in the market when it comes to small caps versus large caps, right? But we've already looked at the large caps and we know it's not because large caps are correcting. We're just seeing there's risk re-entering the market. So one of the ways to think about this is the narratives that take place, right? And the narrative is to some degree that we've had a strong rally and that the market should look to give some of it back, right? Or that this consolidation is bearish because of the debt. And I think what price action is telling you is that this rally could just be getting started, depending on where you look. And that's what we see in something like small caps. This rally could just be getting started for small caps. And it's something we want to keep an eye on. And we can do that via this ETF, right? And so that's kind of the quick overview of how you can use ETFs to really gauge the market in 10 minutes? Right? And then if we want to dive deeper, we'll dive deeper. And so what I want to do next is I want to show one of the benefits of ETFs is the ability to manage risk when individual charts don't necessarily look as good. Because sometimes the ETF might actually look better than the individual chart that you want to look at. And that's one of the benefits, right? So let's take a look here at ITB. Right? So let's take a look here. ITB, iShares Home Construction ETF. Right? You see here, it's been a laggard this year, right? One of the stories around this is rates, which I think makes sense, right? Because people have to get loans. And when rates go up, it's harder to get loans, blah, 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 blah. You guys get the scenario. But what I want to highlight here is that you can see we've come back to this key level back from 2023, those prior cycle highs, and that's where the bulls are starting to step in here, right? And so when you look at something like ITB, if you want exposure to home construction, right, because you think the job numbers was good or that you think yields might fall a little bit, whatever you think, or you think that people are probably getting used to yields. And so as long as incomes and people stay employed, people realize they have to embrace the fact that mortgages are going higher, right? Understand that, okay, 5% is the new 2%. I just have to accept that. I don't know what that message is, but that's why we look at charts. So you look at something like ITB, you have a clean risk reward here against 90. And so if we zoom in on ITB, right? We look at a daily chart. This is for the past year. You look at a daily chart of ITB, you get an even clearer picture of the message, right? You have this RSI divergence, which for those unaware, an RSI divergence is when price makes a lower low and then momentum using RSI makes a higher low. And so that kind of tells you that the sellers might be exhausted, that the rate at which we are going down is slowing. Right? And think about a car, right? You hit the brakes and then you take your foot off the brake and the car kind of glides in. And that's essentially what's happening is you see there's a lack of selling pressure that occurs. And then you kind of see this reclaim of this key $90 level, right? Which if you think about the markets and you understand human psychology, round numbers are where people tend to gather around. It's where significant support and resistance can occur. So what do you have here? You have a zoomed out chart where you saw that you had clean risk reward, and then you zoomed in and then you saw, okay, we had this RSI divergence that's now being confirmed by a higher low and a reclaim of this 90 level. So if this is something that you wanted to get long and you wanted to express exposure in home construction and home builders, this is where you could do it. You could do it via this ETF instead of the individual names because a chart sets up nicer, right? So it just gives you another tool in your toolkit to be able to place trades. Because let's zoom back out and look at this weekly. So we have DR Horton, Lennar, NVR, PH, Pulte Group, and Sherwin-Williams, right? Those are the top 5 components. Within this together, you're getting roughly 51 stocks when you buy this, right? You're getting exposure to 51 names. But you might want to look at those individual names and see if there's individual names within there that have better setups than this one, right? To me, we had a really clean setup here, but let's take a look at those individual charts to see, because now we can look at the components within it that give it a good setup and see if there's better risk reward in those scenarios. And what you'll realize with this one might not be the case. The best risk reward might be actually betting on the ETF. So let's take a look. Let's just start here with DR Horton. Let's actually use the daily for this. All right, DR Horton, not the same setup, right? Not the exact same setup that we saw. I don't like this setup as much, right? I don't think you have as clean of a risk reward scenario as you did because we're still below, right? You can see it here. We're still below those prior cycle highs. Whereas in ITB, we're above them, right? So you might like home builders or home construction. You might want to express a thesis, but the individual stocks might not have the best setups. And so now you could take something like ITB and swing the bat. Let's look at the next name, Lennar. Similar story in Lennar, right? Don't necessarily think, right, if you want to express this thesis, that doing it at these individual levels is where you per se want to do it. Right? We're not only below this level, we're below this other key level. Right? And something like Lennar, this chart doesn't look great, right? I'm just giving an example of a bottom fishing perspective on the ETF in the individual charts, right? But I don't think Lennar looks great. All right, let's take another look. NVR. See, similar, right? We have this similar pattern that I don't think, maybe. Zoom into the daily, maybe, right? But you don't have as strong, you don't have an RSI divergence here, right? You don't have that clean setup here, right? Whereas you can get exposure to 51 of these names and be trading this, right? Be getting long in something like this versus those individual names. So I think that's another benefit of ETFs that goes missed a lot, is the ability that not only can you look at the individual components that make up those names, you might have a cleaner risk reward in the actual ETF than you do those individual stocks. Will you get less juice? Sure. But there's options for that, right? Or you can get the ETF and then get exposure to the individual name. But in general, a lot of people just want exposure to different sectors of the market. And I think ETFs is one of the great ways to do it, right? I think about Bitcoin, right? You think about IBIT, right? This gives a lot of people exposure to Bitcoin that couldn't get exposure to Bitcoin before, right? And you have clean levels in something like IBIT. Right? Getting back above that $60 level in something like this, right? You can put this within a 401k. You can put this in a Roth 401k. Right? You don't have to trade on some weird exchanges, something like Fidelity. You can pop this up and get exposure pretty quickly, right? Something else, huge benefit of ETFs, and JC Peretz talks about this all the time. You can get exposure to international names, which is something you can't really do with a lot of different accounts, right? It's hard to get international exposure a lot of times outside of ETFs. Those individual names, it could just be hard to do. And so that's something else that I think goes unsaid about the ability within ETFs, is the ability to get exposure to different areas of the market. It's something that I think is extremely underrated. The ability to just get that broader exposure, right? The ability to not have to sit in the US all the time, right? Look at something like Taiwan, right? You can look at all of these, DAX, right? Look at the German DAX trading at all-time highs, right? Trading right at all-time highs. Right? You don't have exposure to that when you're in the US, and you might not know what individual German stocks you want exposure to, but this is something you can actually take a look at and understand, hey, I actually might want exposure to this area, and I could do it via an ETF because something like the DAX, right? The DAX has exposure to a plethora of names, has exposure to 44 holdings, right, within Germany. And you're able to get that exposure. Whereas you might not be able to just in an individual stock. You might have to trade an ATR or get in a weird position. But I think that's a huge benefit here. Let's take another look. Keep going international, right? Look at Austria. Similar, right? Trading near all-time highs. You don't think about Austria, but with ETFs, you can have the ability to gain a little bit of exposure there, whereas you normally wouldn't. So that's kind of the message here today was just, I just wanted to show you guys kind of the journey you can take with ETFs and the ability to gain exposure, right, to the broader market, the ability to, manage risk, the ability to diversify, the ability to look at the market from a top down and then a bottom up perspective. And then one of the final ways I like to use it, right, is we can use it to manage risk because we have ETFs that give us interesting exposure, right? Let's look here. This is one of the ways people really like, right? What do we have here? We have high beta, right, versus low volatility. Instead of taking individual names, we're able to take these ETFs and get a broader measure of the underlying strength. And so we can take the breadth of beta and the breadth of low volatility and then make a decision instead of having to rely on individual charts. And what do we see, right? We see that similar cup and handle pattern that we saw on IWM, that we saw on the S&P 500, that we saw on the equal weight. And so you're able to take these ETFs, do that bottom up analysis, and then also look at risk metrics using those ETFs to get a broader understanding of the broader market. So that's kind of what I wanted to highlight on today, guys. It's just this broader understanding of how you can use ETFs to your benefit. And something I'm currently working on is a bunch of different ways to get exposure to ETFs. And just, I think the ETF industry doesn't do a great job of highlighting how certain ETFs can fit in your portfolio as a trader. Because if you were in international ETFs during April, right, you wouldn't have incurred the same amount of drawdown as others. And so that's something we're working on here. I'm excited to kind of show you guys more of the ETF exploration tools that I'm building out and give you guys more insight into those. But let me know kind of some of the ETFs you guys take a look at. And let me know what's your favorite ETF to kind of track the market. Because for me, it's this MAGS ETF for leadership. And then it's the RSP ETF for a quick breadth overview of the market, right? And then we have our all-time favorite, the S&P 500, just gives us that broad overall view. But guys, that's kind of what I had for today. I just kind of wanted to walk you guys through the practicality and benefits of looking at ETFs, when single individual stocks might not be something that you want to be dabbling in at the moment, or something like ITB, you have better risk reward in the ETF. So that's what I had today, guys. I hope you guys have a great day, and let me know in the comments or reach out to me on Twitter at Hostile Charts, right? Put comments in the YouTube chat, reach out Stock Market Media, and let me know kind of how you guys use ETFs in your practice. Thanks.